Hello and welcome to this week's instalment of Nucleus Investment Insights. Today we look at the lucky country's 28 years of uninterrupted GDP growth and contrast that to 7 years of declining real household income per capita. As more everyday Australians are beginning to realise that their share in economic prosperity is being eroded, we thought it was a great time to run through our take on where some trouble spots are emerging that threaten to disrupt Australia's historically lucky trajectory. Joining me on today's flight is Nucleus Wealth's Chief Economist, Leith van Onselen. G'day, Leith.
G'day, Tim.
And Nucleus Wealth's Head of Investments, Damien Klassen. Hello, Damien.
Hi, Tim.
Fantastic. So with no further ado, let's jump into it. So the agenda for today, we're going to start off by looking at the 28 years of success or 7 years of disaster, rolling then into some figures around workers and consumption. We're then going to be having a look at the topic of net exports, capital expenditure, or Capex for short, and then of course rounding out, as we always do, on how these themes impact the portfolios we run every day here at Nucleus Wealth. So to start us off, let's have a look at the first topic, 28 years of success or 7 years of disaster. Who would like to begin? Leith.
Yeah, I'll take the baton here. We've just had the June quarter GDP results out, and surprise, surprise, it was another quarter of growth. The economy grew by 0.5% over the June quarter, but annual growth weakened to 1.4%. And that was actually the weakest annual growth since 2001 on aggregate terms. But the biggest story here is that Australia is actually experiencing a per capita recession. The population's growing by 1.6% every year, and obviously if the economy's growing by 1.4%, that means that per capita, everyone's slice of the economic growth is actually going backwards. But this didn't stop the Australian Treasurer, Josh Frydenberg, coming out. Immediately after the results came out, he sent out a tweet where he said that Australia's just had their 28th year of consecutive growth, and the Australian economy is remarkably resilient. So it's all good if you're in government land. The economy's still growing. I think we're the second. We've had the second longest spell of aggregate growth in modern history. I think behind Japan, and we overtook the Netherlands last year. So according to the bigwigs in government, Australia's economy is still a powerhouse. But not so if you flick to. I've put together a chart here which actually compares the coalition's growth record, the per capita growth record since the coalition was elected in 2003. 2013. Yep. Slip of the tongue there. And what it shows is that Australia's economy has badly underperformed all major OECD economies. The OECD as a whole, the European Union, the G7. We're behind Japan, Germany, United Kingdom, United States. Just to put some figures around that if you don't have the chart in front of you. Australia's GDP per capita grew by about around 5% between 2013 and 2018, and that compares to about 9% for the OECD, nearly 10% for the EU, Japan, which everyone always says Japan's this basket case whose economy is one that Australia shouldn't try and replicate. Well, guess what? Japan's per capita growth went up by 5.8% over the same period, so it beat Australia's. Germany's ahead of ours, United Kingdom's ahead of ours, United States is well ahead of ours. Basically, we are a laggard across the world over the coalition's terms. So the only thing that's making the Australian economy look good is that we're running a world-beating immigration program and a much stronger population growth.
And the other key thing to note over that period is that we went from being a moderately sized exporter of LNG to one of the world's largest exporters now of LNG. We're about to be number one. We've flipped in and out, and that's a big factor in GDP growth. So while we've gone from being a lot of that growth has actually just been this big uplift in LNG, which is all going to foreign companies, and you've sort of lost. You don't see that within the numbers, which is why on the next chart you can see if you come back to household disposable income, that's actually falling.
That's right. So real per capita household disposable income is actually lower today than it was 7 years ago. So I put up a macro business earlier in the week, maybe it was late last week, that Australia's had this 7-year recession that no one talks about, but I was talking about the falling real household disposable income growth per capita.
And sorry, can you just explain then, Leith, just the difference between the GDP per capita and real household disposable income?
Yeah, so real household disposable income is obviously what households get in terms of income, wages, etc. Whereas GDP counts other stuff. Like it counts, GDP is basically a volume measure, and it counts net exports, etc. So GDP captures both corporates, government, and households. So it captures all three sectors. Whereas the one that really matters to, let's face it, what matters to the ordinary Australian is not what's happening to corporations; it's what's happening to households.
Yep.
And their incomes have basically been going backwards for the past 7 years. And just to add to Damo's point where he said that about LNG exports, that's propped up GDP growth because we're selling more volumes. But apart from the fact that most of the gains the income goes primarily overseas because they're foreign owned, it's actually worse than that because the LNG exports are actually pushing up domestic energy prices through gas prices. So households are effectively paying this private tax on top of that, which is also, it doesn't it's not captured in the income figures, but it raises their costs.
Yep.
So it's effectively a boom that actually sends households bust.
Yep.
So it's even more negative than that.
Fantastic. Okay.
Yep. And so then to put that into sort of a bigger perspective, now we've got a chart up, which is the next one. And it's probably, you might need to go to one of the websites where we've posted this and have a look. Nucleuswealth.com or Macro Business has got it on there, a few other places. And what we're trying to show is really just in big picture sense, how big are different areas of the economy, and then how fast are they growing either on an annual or a quarterly basis. And so we've got these sort of bubbles that sit on the chart that show where's green and where's red, which is the greens are parts that are going up and the reds are part that are going down. And that's where we're going to focus in on this as we go through the rest of this presentation. So the idea was that there's some pretty clearly from here, you can see there's some pretty dark red on the investment side. So the investments are definitely falling. And so we want to have a look at that area, which is the capital expenditure side. The government expenditure, government consumption is very strong at the other end. So spending a lot of money, not on government Capex. Government Capex has actually been a little bit weak recently, and we'll go a little bit more into that. But there has been some strong spending in government circles for their sort of ongoing expenditure. And also
NDIS is a big part of that.
Exactly, yeah. And so that's a major part of those. And then the other parts that are key is that exports is very green in terms of that, and the consumption's quite weak, and so we'll sort of dig into a few of those areas. So consumption sort of running at that same 1.4% for in total, which is negative on a per capita basis.
Okay.
So people spending less money. And so that sort of gives you a sort of big picture sense of what's happening within the economy, and then we'll jump in sort of bit by bit and have a look at those.
All right, sure. So workers and consumption?
Yeah, so consumption's a really important one for the economy because it makes up around 55% of the nation's growth. So it is the primary driver of the economic growth, both domestic demand and GDP. And the notable thing here is that over the past, it's really been going on for the past 30 years, but especially in the last decade or so, the wages share of the economy. So this is how much of the nation's income is going to workers in wages. It's actually fallen to the lowest level since the Beatles toured in the mid-1960s.
Oh, there's a nice stat for you.
Yeah, that's right. I better give Greg Jericho a plug for that one because he actually used that line. So, which I thought was pretty good, so I stole it.
Happier times back then, I think.
Yeah, that's right. So just to give you a bit of perspective, back in the sort of early 1980s and the late 70s, about 60% of national income went to workers, and now it's fallen to about 51, 52%. So it's been falling for decades, but it's fallen to the lowest level since the mid-1960s. So this sort of tells the story again. The aggregate economy's looking all right. Well, not great. It's still pretty bad, but it's looking a lot better than obviously what's happening in the households, which again is why we've got this 7 years of real household disposable income.
Well, it's masking it essentially.
That's it. Yeah. So the government can say, "Oh, we've got growth," but obviously the per capita economy is bad, but the per capita household, the average household, is even worse.
Yep.
So it's a pretty bad picture, and as you'd expect, when you've got such a low share of the nation's income going to households and household disposable income effectively falling, eventually it's going to impact consumption. And we're starting to see that now with real household consumption's now fallen to around about the lowest level since the global financial crisis. We sort of hit the same level in 2013, but the trend's pretty bad here, and that's precisely what you'd expect. So obviously households are struggling with income, and the situation would actually be worse than that if it wasn't for. And we've got another chart here, the next one. The next chart shows that the fall in household consumption has actually flowed through to retail sales, where real growth is actually the lowest since the early 90s recession.
Right.
So falling consumption, but that's also been impacted, by retailers. This is why we've got retailers, all bar JB Hi-Fi, pretty much reporting, weak trading results and etc.
So it's basically zero.
Yeah.
With an extra 1.6% people coming
That's
in
right.
every year.
Yeah, so again, negative I didn't bother deflating it by per capita, but it's just, on an aggregate term, despite the fact we've got a very strong population growth historically, it's the lowest since the early 90s recession, so it's pretty much at recessionary levels. And it would, in fact, be even worse if you're watching this live and you've got the chart in front of you. I've got a chart on the right there which shows that the household savings rate's fallen to the lowest level since the global financial crisis, in the post-GFC period. So what this means is that households have effectively been leveraging up on debt and drawing down savings in order to maintain their consumption in the face of falling incomes. Now, Australia's household savings rate should be positive. The default should be pretty strongly positive because we've got obviously compulsory superannuation, which gets counted in that.
Yeah, right, okay. Yep.
And the fact that it's fallen means that it's fallen beyond what's been compulsorily saved.
And also the record low interest rate environment as well surely would feed back into that, would it? In terms of after debt repayments and everything else?
Yeah, this is more the... I guess that probably helps you a little bit, but I think that's also exacerbated the other side of the problem is that people keep taking out more debt.
Yeah, they're levering up. Okay.
Yeah, it's great we've had lower interest rates, but rather than take that saving and use that to save money, people have gone, happy days, I'll double the size of my house, thanks.
Yeah, okay.
And despite the fact we've had this, obviously housing creation, etc., the household debt to disposable income, partly this reflects the fact that disposable income's falling in real terms, that's still rising. So we've got basically households borrowing to maintain a really crappy level of consumption, which is obviously not sustainable. I mean, you can't borrow forever. And even if that's stabilised, that would drag down consumption, let alone if households just decided to save again. That would obviously also hit consumption. So it's pretty weak across the board there.
And I guess the main point for me is that it's hard to see what's going to change. So where we're sitting at with this, so this is our first part, is workers and consumption is very weak and potentially can get weaker as that savings, people even just stabilise the savings ratio. But it's very difficult to see any policies or any changes and that is actually going to make any meaningful difference to any of these things we're talking about. So at the moment, I think that the hope is that house prices, the government's throwing a lot of resources at trying to lend more money to people in the housing market, with the hope that stabilising house prices will then mean that everyone gets out and spends money. And I guess where I'm positing is saying, well, that's a difficult argument to have at this point because as wages keep getting lower and you're not doing anything on the wages front, and it's almost you've ruled out all of the tax changes that might have helped sort of spur productivity, is that until we actually see something change, it's from a policy level or from sort of a macro level, you have to expect more of the same.
Yep. Okay.
In this area.
Fair enough. Okay, we'll roll into net exports. So we've got a couple of good charts here. And just as a note for anyone who's listening on the podcast, of course, there is the show notes. In the show notes, you'll find the webinar slides in a PDF form. There's a link there. But we'll kick on to the boom's effect on the real economy is over. That's a good starting point.
Yeah, so what I wanted to do here was contrast the two parts. So on one side, on the left-hand side, we've got the exports from oil, coal, gold, and natural gas, and you can see all of them are sort of a nice upward sloping line in terms of the money that's coming in from those sectors.
Except for gold, that's the one.
Except for gold,
Yeah.
yes. Then you go, okay, what effect is that going to have on the Australian economy? Now, because a lot of these are foreign-owned companies, and particularly in the LNG space, in the gas space, where a bunch of foreign companies have come and set up very large projects in Australia and spent a lot of money to do so. And that's where you can see the on the right-hand side, we can see the mining Capex going from sort of 1% to over 6% of GDP in terms of the amount of money that's been spent. So Gorgon alone, so it was a space over a number of years, but this huge project was almost 5% of Australia's GDP. Just one single project that added to employment and
the wealth effect, I guess, essentially.
Yeah, manufacturing and all these other things that went
property.
into that. Yeah, that's over.
Yep.
Now they're just putting the final touches on it and scaling everything right back. And that's the case right across that entire sector. So we can see that the Capex has sort of gone from 1% back, right up to that 6%, which sort of coincided with that the bubble we're seeing in the middle of the export graph. So basically, the exports all kicked up. Everyone went happy days. Look at all this money we're making. Hey, what we really should do is go and set up more of these projects. And so then they rushed out and put on all these other projects, and that then led to this huge Capex boom, which was great for the Australian economy. We've seen now, though, from the 2017 onwards, we've seen that line then pick up again as, first of all, as the LNG exports actually start, and secondly, as we've had this sort of second mining boom from a lot of it's iron ore based, where Brazilian mine issues and the price we've seen for iron ore's gone significantly higher, but that hasn't had an effect on the Capex this time around. Right. So if you're not getting the transmissions from the resources sector through to Capex, and also our LNG royalty regime is basically, I can't remember the exact numbers, but I think we're getting sort of $500 or $600 million in royalties, whereas Qatar, which is basically level with us, gets like 20-something billion dollars in royalties from theirs. Yep. So we're just like chalk and cheese in terms of the amount that the government's actually getting from it. So there's sectors in the Australian economy that are doing quite well, but they're foreign owned. They've got all these huge tax losses, so they're not paying any tax. They're not paying royalties because they struck a great royalty deal. And so the rest of Australia is just not seeing the effect of it.
And also the mines are becoming increasingly automated as well. So the Reserve Bank did a really good paper during the height of I think 2012 it came out, during the height of the mining, the commodity price and construction boom. And they said that about 10% of the economy was employed in mining or mining-related industries. But most of that was the construction side. Yeah, that's right. And it's only about 2% of the actual, less than 2% of the actual economy is employed in actual mining extraction. And as Damo said, now we don't have the construction to go along with it. That's wiped out a lot of jobs, and that's wiped out the transmission mechanism between these rising exports, rising commodity prices, and Australian workers.
Yep. And so that's why GDP looks good, but the effect for the average person on the street is no different. So we're going backwards in terms of household income.
Because GDP measures volumes.
Yep.
So in terms of commodities, it measures tons of dirt or whatever shifted. No, the value. It's all about volumes. So it's it doesn't do anything it's not doing anything for the household income side. Yeah, it's not a lifestyle measure. It's of course not. It's a flow measure.
And you can argue this is why you get political instability from these, and you could argue that the rise of politicians like a Trump or a Boris Johnson come from the fact that the average worker in a lot of in Britain and the UK, Britain and the US, has done quite poorly out of the whole boom. And when politicians turn around to people and say, "Hey, you guys have never had it so good.
Yeah, the numbers are fantastic.
Look at how good these numbers are," and people are sitting there looking at their pay packet going, "Just a minute, I'm not seeing that." Is when you get the rise of politicians that then come up to say, "Well, I can fix that for you.
Yeah,
let me sort it out."
Yep.
Australia hasn't had as much of that problem because we did have that mining boom to to really push
It was like
$100,000
shock absorber essentially,
truck
wasn't it?
drivers and all that type of stuff. But since 2012, we have, and so that's the question now is whether that's where that leads politically. But I guess coming back to that main point on the export side is net exports have been great, but they don't do anything for the average person in the street.
Yep. Okay. Sure thing. We'll jump across to public capital expenditure.
Yeah.
As well.
So
or capital expenditure in general.
I've got two capital. So we spoke about the mining capital expenditure. Now I wanted to focus in on the other two parts. So the other main parts is this is one area where we've seen there was on that big graph there was some really red spots on that graph. And so the question is, how much further can that fall? So if we're looking at GDP and what's going to arrest the fall, quite often it is that capital expenditure goes through these cycles.
Yep.
And you have like a boom period, and then you go through a bust period, then you go through another boom period, and the economy then follows behind that in terms of the spending starts and it pushes through the rest of the economy. So there's a lot of talk out there about how large or how much money that's being spent in terms of these big capital expenditure projects, new railways, new roads, infrastructure.
NBN.
We're talking, NBN. We're talking about how we're probably going to need a fair bit more water, coming up over the next little while.
A few diesel plants in Sydney.
Yep.
To cope with extra population. The issue is on two parts. One is on a per capita basis, it doesn't look as good because the net result is, yes, you're spending lots of money, but if you bring in all these people every year and population is growing, then you need to do a lot more than what you're doing in the prior years.
Yep.
But also there's this little bit of a hole coming up over the next year or two as some of these bigger projects roll off. And so we've got a chart up here showing the major public projects. So this is government spending. And you can see the peak was there in 2017-18 and is slightly lower in 2019. And there's another bigger step off into 2019-2020. Now, having said that, I take the longer term measures on this with a little bit of a grain of salt because you can see big changes to the forecast numbers, so you can't take them as gospel. But look, the 2018-19 numbers we've seen that yes, they came off. The 2019-20 are pretty much baked in. It's pretty hard to go out and spend lots of money on Capex projects, even as a government, in such a short period of time.
And there's fairly long lead times, isn't there?
That's right,
with government Capex as well.
Absolutely.
And there's also a lot of concern at the moment about being, not enough capacity in concrete, in labour, etc. So that they are reportedly running against capacity constraints and how much they can actually build more.
I still reckon though that with the apartment boom coming off, then that'll free up.
Yeah,
from a labour perspective,
but also all the concrete and all those other factors.
Yep.
But I guess there is that point about saying, let's say there's this big project you want to do, an ultra fast railway. It's a favourite of Leith's, I'm sure.
Out to Geelong.
He said, let's go spend a couple $100 billion on building
on a white elephant.
Yeah. If you rushed out and said, okay, that's it, we really got to do this to get the economy going, you got 3 or 4 years of
before you even start.
Yeah, that's right.
And you can't spend lots of money because you're basically you're getting engineers to do a bunch of things, to all the planning and all that type of stuff. It's not a matter of let's get a whole bunch of bodies out there on shovels digging stuff.
Yeah. Well, a classic example of that's the supposed $50 billion rail loop in Melbourne.
Yep.
That's supposed to be built over
the outer ring.
Yeah. It's actually going to be more like $100 billion. But aside from that, the government says that this is a 30-year project. And they reckon they're not going to even start doing any kind of this construction until 2022.
Wow. Yeah.
So they're just spending money on, consultants' reports, blah, 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 blah. So
and you got to acquire the land and there's
a lot of stuff.
Yeah.
And so...
meanwhile, the boundary of Melbourne is just marching further and further out in every direction as well. Yeah. It's probably compounding that issue a bit.
Yeah,
but anyway.
We won't get you guys into the soap. Don't let Leith got any soapbox about
exactly.
I'm just stoking that fire, but anyway.
Yeah. But I guess the...
long lead times.
Where it comes to is long lead times. The next couple of years, we're actually looking at falling government capex. Then you say, okay, what's happening on the private capex side? Because mining's one part of it, and I've got a chart up here that you can see the big sort of mining boom up there in 2012, where so this is showing private capex how big it is a percentage. So we saw that mining sort of went from 1% to 6% of the, and then it's back down to a little bit under 2% at the moment. The rest of the economy sort of generally cycles somewhere between 6 and 10% of the, or maybe a little bit lower than that. And the issue is, so we had this big mining boom that pushed out a lot of other capex. So you went, okay, well that meant manufacturing capex that could have been done or others just didn't get done because the Australian dollar got pushed so high. We had all the car manufacturers all closed down.
Yep.
So all this capex that could have been done was literally squeezed out was of the economy. And what that's meant is the fall has happened. So now we've gone back down from 11% back to almost 6% now,
which is a halving, essentially, nearly. Yeah,
close. Is that now you're saying, okay, well, great. Now all our car manufacturers and all these other guys can now start spending there, and they're like, well, yeah, they've already closed down.
They're shut.
Like they're not.
They've left the building.
Yeah, you need to get to the stage where those other sectors do want to spend money, and it isn't looking close. So if you run through the bigger sectors, so manufacturing, for example, has fallen from sort of 2%-ish of GDP down to 0.5%, and just showing no signs at all of coming back. Like there's still capex happening within the sector, but no signs of it increasing its share.
Yep.
You look at the telco side. So we had this big spend on the NBN, which was not only a lot of that was subcontracted out. So you did see private sector as well as public sector.
Yep.
But that's coming off now. So that's now past its peak. It's in the rundown stage. So again, you're seeing that fall. So when we look through the private sector capex, it's probably pretty close to its bottom. But it's again very hard to see what's going to turn that around.
There's no industries left to self-stabilise it.
Yeah, you sort of need effectively you need a lower currency to get to the stage where these will come in, and that's where the RBA is actually out there, and it knows that's what it wants to do. It doesn't want another housing boom.
Just wants a 50-cent
it would
dollar.
It realised it'd be better off without another housing boom, but with a lower dollar, so that then you can bring in more of this other capex to sort of help start the next cycle. But
it's also why the RBA is trying to pressure the federal government to boost infrastructure as well. So,
yeah, that's right.
And business.
Yep.
But again, you can see where we are. Like not only with the lead time of saying we've got a lead time now of trying to convince the government, hey, things are pretty bad. You really should get out and spend infrastructure. With the government saying no, we need a surplus.
Yeah.
And so you need a lag time for more bad economic data to hit for them to then go, oh, okay, yeah, we do actually need to spend more money in infrastructure.
And by that stage, it's going to be, there's a lead time.
But and would you say that the infrastructure spend, though, is sort of like a bit of a panacea in the sense it's a stopgap thing that they can use in an emergency? We can just, we can create a project that lasts, say, 3 or 4 years or 5 years, as opposed to an industry which runs for 50 years and hires, tens of thousands of people, which, those have sort of vacated in a way. And the infrastructure for mine, outside of the Ponzi sort of, relentless sort of requirements, as you say, when it rolls off, we've probably had 2 or 3 prime ministers by then as well, so no one really knows where the tail's going,
But and you need to keep building more to keep growth going.
Well, you just got to keep pulling this one lever, because all the other self-stabilisers that pick up when mining booms roll off in corporate capex is missing.
And having a housing boom, having housing booms help in terms of construction. Housing construction booms help, but trying to engineer a housing construction boom because of all the extra people you've brought in to build stuff for the people that you've brought in, and then you've got to build stuff behind it, and you're sort of saying, well, just a minute, we're only creating our own demand.
Yeah, that's right. Yep.
You would be better off having...
We've got a circular reference here.
Yeah, exactly. So, so that sort of brings us back to the sort of investment implications, which is saying, okay, we've given you these 4 areas of the economy that are having positive and negative effects, but it's very hard to see what's going to change in any of them. So, we seem to be stuck in this loop, and it's a grind lower. And so at the moment, it seems to be as if the hope is we'll spend. We're basically either praying for another disaster in somewhere like Brazil that pushes commodity prices higher. Short term, once again. Exactly. Short term save. A disaster in one of our competitors for resources, which will send prices higher, which has worked so far. Yeah, sure. But it's not it doesn't sound like a good long-term plan. And waiting, looking at the Australian economy and saying, well, what's going to change within the structure at the moment? Interest rates have been lowered a little bit, but nothing significant. Yeah. And we haven't got any scope on that front. So if lower interest rates were going to be the miracle that turned our economy around, that would have happened years ago.
Because it's been happening for.
So at the moment, in terms of the way we look at it from an investment perspective, is saying we're in this grind lower, and we're stuck in this grind lower until something changes.
Searching for an answer, sort of thing, essentially.
And the hope is the thing that changes will be a positive change in terms of structural reform, or big infrastructure spends, or something that actually pushes changes the dynamic of the Australian economy.
Yep.
And not a negative effect, which is a big offshore shock, which then pushes things lower. So when you're stuck in this part where you're saying we have an Australian stock market that's quite expensive, we have little chance of positive outcomes. So there are certainly positive outcomes, but the chance and the upside to positive outcomes is relatively limited. And then you have the possible big negative shock of something happening offshore, or the housing unemployment rising in Australia and the housing market not managing to hold on. And so that sort of leaves you with that part of saying, look, there's better assets to own than Aussie equities out there.
Yeah, okay. Yep, great answer. And just a note for anyone listening in, to feel free to drop in a question. I've just got a quick one. So so obviously just recently been through the ASX reporting period, Australian company reporting period. And Leith mentioned before, so retail obviously in the doldrums, and plenty of evidence to sort of show why that might be the case. From your experience, Damien, just keeping an eye on, obviously you mentioned we are very underweight Aussie equities, but we do have some exposure, so obviously keeping an eye on everything. Are there some surprise green shoots? Is there something in there that sort of is coming through from maybe the GDP explaining that as well, or is it, was there some surprise in the upside from a sector basis as opposed to an individual company that shows that there is some movement? Could it be a services or a healthcare or those sort of things, and then maybe the other side as well? Look,
healthcare is strong.
Yep.
Depending upon which companies you're looking at, obviously, but there are positives in healthcare, and a lot of that's NDIS, so the National Disability Insurance
Scheme.
Yep, that's the one.
I'm just trying to remember the right word for the acronym. I know the acronym, but so that's driving growth in a number of those areas. So, and associated businesses, and also that is helping. That's helping a portion of quite low income workers, which is a positive.
Yep. And sorry, just to interrupt there quickly. The latest wages data came out, shows that the healthcare and social services sector, which is actually growing quite strongly. So the wage growth there is the one bright spot for the economy. It's growing at about 3.5%, whereas the rest of the economy's wages are obviously very weak.
Ex public service.
And yeah, that's right.
Well, the public service numbers aren't good, and there was a point the RBA's been making as well, without some hypocrisy, in that the RBA's been making the point that saying to the government, well, you got to let public servants' wages rise, because otherwise you can't expect private sector wages to rise if you're not giving more money to public servants.
Yep.
To which there's not going to be a
wrong
response
government.
to that. Yeah, wrong government. Yeah. But having said that, the RBA itself gave quite meagre wage rises to its own staff.
Yeah,
but they are shockingly overpaid.
I was going to say 1% of 1 million is still pretty handy.
Well, I'm talking about the
percentage change.
The notes and the people, the guys actually printing the notes and all that. The unions there got a very small pay rise. They was talking about striking to get higher wage rises.
Yeah, right.
Small. So it is there's a talk about expectations for inflation and how that gets embedded in economies, and how they need to maintain that higher expectation for inflation, because once a low expectation gets ingrained into economy, then wage rises get pinned to that expectation.
Yeah, sure.
And I would argue we're already there. We've got the RBA's own, when they're looking at their own staff and their own, they're factoring in this. The federal government's sort of saying, well, no, I'm not going to give any more than whatever 2% pay rises, because, and you're looking at going,
so they need to.
And we're trying to get inflation of 2.5%. That's the goal. The goal is 2.5% inflation.
Well,
anything in theory, if we were going to actually get there, which we haven't been, in theory, any wage rise less than 2.5% is a pay cut.
That's right.
So you should be starting. The point for all these should be saying, well, there's probably some productivity gains in most industries. The starting point probably should be 3.
Yep.
But the starting point tends to be 1.5 or 2.
Yeah.
It's the classic case of do as I say, not do as I do, and everyone wants everyone else to pay more in wages, but they don't do it themselves. So pretty much if you're a corporate doing that, if you're federal government, you're doing that, state governments, etc.
Okay. Yep. Sure.
So that was a long-winded way. Healthcare was one.
Yep.
There is some of the resources. There's some of the manufacturing side. I guess the equipment side for that is starting to flow through.
Okay.
So there's a bit of a positive signs there, but the construction side, there's no big projects coming.
Yeah.
But some of the equipment.
And real estate investment trusts and those sort of things, they seem to be had a good run of late.
Yeah, I think a lot of that's been bond prices
interest
rather than anything else. I think you look at your rents, and your rents are pretty much you're limited now by people's incomes not rising, and so and poor retail sales.
Yep.
And so on the rent side, it's quite difficult as well to get much growth.
All right, sure. Just got a quick question here from Stomper, a listener. Correct me if I'm wrong. But aren't many of these projects excluded from the government budget? Sorry, I'm imagining this is a government Capex because they're built for later sale to corporations. NBN, Westconnex, given as examples. They increase government debt, but the costs are borne through tolls and charges, so they're quarantined from the budget.
Yeah, it's off balance sheet, a lot of it.
Okay.
Yeah.
Right. So they wouldn't be in those government Capex figures?
I believe they are.
No, they've been in the Capex figures. They're not in the budget balance figures.
Yeah.
Right. Okay.
So the trick there is you still got to spend the money, so it still comes through in the Capex.
Yep.
But then you just, from a profit and loss perspective, with air quotes around profit and loss perspective, is you say, well, they're not part of my P&L.
Yep.
I'm just going to move them onto my balance sheet, and then I'll sell them and take a profit or loss on the sale of the asset.
Right.
So the Capex is effectively a cash flow type measure.
Yep.
Trying to measure what's actually been spent. But then from a budget balance perspective, I can still say to people, hey, I've got a surplus.
Yeah.
And then try to sell the assets.
But I think Stomper's point was, for example, there are cases with the Westgate Tunnel where the government's not actually taking the investment. They've done a cozy deal with, say, Transurban, for Transurban to pay the bulk of the cost to extend tolls for 15 years. So that doesn't actually come out of the government balance sheet, but we're all going to be paying for it through private taxes because through tolls, which is basically private tax. Same diff.
But also we see that in the private Capex numbers, and actually within those private Capex numbers, that was actually one of the ones one of the charts I didn't put up was that's been the case. I can't remember the exact scale, but I think it's about 0.5% of GDP where we've basically moved from government spending on water, toll roads, rail, those types of factors. Might have been as much as 1% of GDP over the last 15, 20 years, which has effectively just been moved from government to private.
Yep.
So yes, you won't see it in the government numbers, but the effect should be we should see on the private side, we should actually see all those that number that was sort of trailing down on the private side actually be ticking up because of these other projects.
And you'll pay either way, whether it's through tax or through tolls.
Yeah, sure.
Or through private tax or public tax. Same diff.
All right, fantastic. All right, well, on that note, we'll finish up. Thanks very much, gents. And coming up next week, we're going to be looking at the ticking debt bomb. So corporate debt levels around the world, and I think we're doing a focus on the US as well. So that's same bat channel, Thursday, the 19th of September at 12:30 Eastern Standard Time on our Nucleus Wealth Live webinar page. Look forward to that, and I believe our Chief Strategist, David Llewellyn-Smith, will be joining us. So if you're listening in, David, we'll see you then. And on that note...
Well, that's it for now, and thanks for watching. If you like what you heard today and you'd like to hear more, head over to nucleuswealth.com/subscribe. Give us your email address, and in return, we'll send you a weekly email with new webinar topics, links for our podcasts, and other news from Nucleus Wealth. I certainly hope you've got something out of today, as I have, and we'll look forward to catching you at the next one. Cheers.